the 60-40 strategy. The problem with that strategy, according to Mark, is that you're giving up a lot of upside in the market. And that's really where your returns come from. And the market has historically done pretty well. The problem is that the market can be really volatile sometimes and go down a lot. If you protect yourself during those volatile times and you have a trade that will give you this big infusion of cash when everything is down and are more attractive, you're going to do pretty well.
All right, guys, bang, bang. I've got Scott Patterson here. Scott is the author of Chaos Kings, How Wall Street Traders Make Billions in the New Age of Crisis. It's a fantastic book, specifically covering Nassim Taleb and Mark Spitznagel. Scott, I thought a great place for us to start our conversation would be around this idea of a crisis hunter. That is a phrase that is used a couple of times in the book and seems to be a great way to label what these guys are doing. Is that a new concept, or have people always been kind of hunting crisis? It's just now with the way that the finance industry is set up, you can actually make money off of it.
Yeah, it's interesting. Crisis hunter was what they, Nassim and Mark called themselves when they launched their first hedge fund, Empirica. And it was also one of the original titles of the book, Crisis Hunters. Talking with the publisher, we changed it to Chaos Kings. It's a little catchier, but they invented this concept back in the late 90s. It evolved in their first hedge fund, Empirica. And as far as I know, no one had ever created a strategy like this that delivers these explosive returns when the market crashes. And it was pretty successful back then. They shut it down mainly because Nassim couldn't handle the stress of the trading, because it's a very stressful strategy because you actually lose a lot. You're consistently, you don't lose a lot of money, but you're losing a lot over time. The idea is, you might lose like a year or two, and then when the market crashes, you make way more than you lost. That's how it's supposed to work. Mark relaunched it in 2007 with Universa, and pretty good timing because 2008 saw the global financial crisis. And an interesting story I tell in the book is how when they launched Universa, which people look at now as being this very successful hedge fund managing billions of dollars, no one wanted to invest. It was such a weird, unique strategy that people just didn't get it. They traveled the country talking to portfolio managers, pension funds, family offices. And, everybody looked at this and said, wait a second, I'm going to be losing money month after month on this thing. Like, that's terrible. Traditional Wall Street strategies like very smooth, consistent returns. Problem is, strategies like that often have what Nassim calls hidden risk, and they can suffer a lot during these crises. So they have a very lumpy return. Year after year, they're losing several percent, and then all of a sudden they make 1,000% or 2,000%, and it's designed to be like, time to crashes, protects portfolios. It also gives investors a big chunk of cash when everything else is down, so they can take that and plow it back into the market.
So you start the book talking about Ackman, Bill Ackman, obviously during the pandemic. He had put on basically an insurance protection using somewhat similar strategy, a couple $1 billion there that was able to offset losses in kind of the long portfolio. Talk a little bit about this idea that, like, in this hyper-connected world, people are predicting that there's going to be more and more volatility. And ultimately what this is doing is it's profiting off of that volatility. And so, yes, Nassim and Mark seem to have kind of pioneered this as a standalone fund with this specific strategy, but is it really that different than maybe some other hedge fund managers may be doing when they're hedging or when they're trying to specifically protect the portfolio that is long?
It depends on how the strategy is implemented. So, what Ackman did in early 2020 was a strategic trade based on his assessment of what was going on in the world with the pandemic, with markets. And he saw early on that the risk that he understood COVID posed to the world wasn't being priced into assets yet in, say, February, early March. So he was able to load up on these positions pretty cheaply. I think he only put in like $26 million, and that turned into 2.5 or 2.6 billion when the market crashed. So that's a strategic trade made on timing, like just similar to what a lot of the big short guys did for the housing market in the mid 2000s. That is not what Universa does. Their strategy is basically you always have that big short on, no matter what's going on. You don't make any predictions. You don't try to time things. It's just there because according to Nassim's Black Swan view of the world is that nobody can predict these things. They come out of the blue. They happen so fast that it's extremely difficult to trade on them. Like Ackman did it. I see what he did in early 2020 was a trader at the top of his game. I mean, he was really moving. And one of the crazy things that he did was he got those billions and he put a lot of it back into the stock market in March of 2020, which is who does that? But that trade earned him another billion. This is something that it's just very hard to do on a consistent basis year after year. So the universe strategy is you don't time things, you just put it on. It's what they recommend is you put about 3% of your portfolio into that tail hedge, and the rest that frees up your rest of your cash to put into stocks.
Now, this has obviously become a very, very popular strategy if you just look at the AUM, right? I think the latest numbers that you include at the end of the book is Universa has about $20 billion of assets under management. They have 21 employees, right? So kind of $1 billion of AUM for every one employee. And you mentioned that when they launched, they only had $300 million or so of assets. And so as they have got more and more adoption, they've now become one of the top 25 largest hedge funds in the world. When you see that, is that just people kind of buying into the idea of the kind of tail hedge? Is that them doing a better job of marketing? Like what's driving so much AUM going into that strategy now? And is it something where, they went from 300 million to 20 billion on their way to 100 billion? Or how do you see kind of that future life of how big the fund could actually get?
Yeah, their AUM has moved up and down a lot over the years. So it jumped up pretty quickly after the global financial crisis. And then it's, one of the challenges they've encountered is keeping investors in the strategy, because after a few years, a lot of them look at it and say, hey, I'm losing this money all these, past few years. I don't think the market's going to crash. Everything looks fine, and they pull out. So I tell some humorous and sad story really about CalPERS and how they were making a big investment in Universa in starting around 2016, 2017. They were putting billions into Universa. And by late 2019, they had about, I think, a position of about 5 billion. And then a new manager took over, looked at the tail hedge and said, this is a waste of money. We're just losing cash. It's never going to get big enough to matter for us because we're hundreds of billions big. So in early 2020, a couple months before COVID really hit, they eliminated their entire position at Universa. So that's one of the hard things about this strategy is keeping people in it. So CalPERS gave up a lot by pulling out. Why is it so big? I think that the strategy definitely is catching on, and more funds are getting into it. I've been getting feedback from fund managers, tail hedge fund managers who've read the book and say like, "Oh, it's great you're writing about this because it's really important and it's effective." I think people are starting to figure out it's effective, and it's I write about, and as Mark and Nassim have talked about, their strategy doesn't fit within the standard portfolio theory propagated on Wall Street and in finance schools that try to that favor strategies with low volatility, that are smooth risk-adjusted returns. You manage your risk in a way to maximize your returns. They do pretty much the opposite of what modern portfolio theory recommends. They have extremely volatile returns. losses year after year, and then big jumps. And that just doesn't fit within the models. I think that people, Wall Street is starting to figure out like, okay, doesn't fit the model, but it works, right? So yeah, there's a lot more funds out there. Universa's got 20 billion. We'll see if it grows. Maybe, people really freaked out after 2020, the pandemic, and I think it woke up a lot of people to the fact that there is increasing risk out there. And, as globalization expands, as connectivity expands, that's, one of the driving forces of COVID was, airplanes, people getting on planes, from the Milan fashion show and, flying back to America or other parts of Europe, carrying the virus with them. That a lot of epidemiologists say this is a new world we're living in, where these viruses are going to spread more rapidly and create the kind of chaos that we saw that year. So I think that's one of the big things that's driving the money flows into these tail hedge funds.
What's fascinating to me about both Nassim and Mark is that they both kind of figured out this strategy separately in their past life before they started the hedge fund, right? And you tell both stories, obviously, with Nassim kind of doing it in the finance world and trying to understand it. But also you talk about this principle of like maybe most of finance is based on the idea that everything is normal and then the outlier is the volatile situation. But maybe actually we should flip that on its head, and the volatile situations are the normal times, and it's the periods of kind of no volatility that is the outlier. And the reason being, if you take away the top 10 trading days a year or something, it's like pretty much flat, and year in, year out. And so it really is all about the big moves, either up or down. And so is it something where we've almost educated an entire generation of people in finance in a perspective that fundamentally Nassim and Mark just reject because of the work that they had done and kind of the experience they had going into this?
Yes, I think it's one of the key insights that they both had is that it's not focusing on the day-to-day returns. Those are going to come. If you're in the market, you don't really need to work that hard to get those returns. What you really need to work hard on is the big crashes. And Mark likes to talk about the scenario that I think is pretty illuminating, where if you have $100 in a trade and it goes down 50%, in order to get back to where you were, you need to make 100% return, which is pretty daunting math, right? So what you need to do is to protect yourself against that 50% decline. And if you can do that, you're going to live to trade another day. And the incremental returns will just come if you are in the market. You don't need to have a real fancy trading strategy. And yeah, I tell this story about Mark when he was an early, cub trader at the Chicago Board of Trade in the 80s. And he learned this lesson with this veteran commodity trader, Everett Klipp, who taught him something that's very contrary to what most investors are told, is that you need to love to lose. And this trader just beat it into him over and over again, telling him, this is against human nature, of course, but you need to get this into your strategy. And what that meant as a trader on the floor of the CBOT is if your position starts going down, get out of it. Just get out of it right away. Learn, live to trade the next day, and you'll survive. And that is kind of, it's very similar to what Nassim was doing at the same time by buying these derivative contracts that usually lose money. They're big bets on extreme moves. Usually doesn't happen, so you lose money on that trade. But when it does, when you do get an extremely volatile event, you make way more than you lost. Huge returns. As like I also tell a story of Nassim's trading on Black Monday, when positions he bought for a couple pennies were trading for $4 or $5, and that's the magnitude of that return does not fit within any parameter of a model. It was so far outside the models that it was something like a trade that like that could only happen in once every 5 universes, according to the math. So he learned early on. Both of them learned lessons, kind of from different perspectives. But when they met in late '99 at New York University, they had this mind meld where they just kind of saw that they were doing the exact same thing, and it worked. They really clicked.
So they're two very different people as well, right? You at one point talked about how like Mark went a couple of times, I think, to kind of the intellectual debates that Nassim would hold. He'd kind of like hold court in these like cafes or libraries or whatever. And Mark basically was like, I'd rather like jump off the building, right? Like, this is horrible. This is not for me. I think you described him as like more serious, whereas Nassim was very much like kind of an academic in nature. Is it a thing where opposites attract? Because you also talk about this idea like they just enjoyed walking around New York City or other places and kind of talking and arguing and debating and all this type of stuff. Or is there something else driving the relationship as to why they had so much respect for each other and why they had been able to work together and really kind of pioneer this strategy?
Yeah, they definitely had similar worldviews. Like they were both into libertarianism. They read some of the same philosophers like Popper. So there definitely was a chemistry there that worked. And at the same time, like you say, they're totally different people. Nassim is, he calls himself a flaneur, which basically means like strolling around town aimlessly and popping into bookstores and museums. And I always envisioned, him wearing these loafers and a silk scarf. You would never, as I say in the book, you would never hear Mark Spitznagel call himself a flaneur. He is the opposite of that.
Yeah, he's the anti-flaneur.
Huh?
He's the anti-flaneur.
He's anti-flaneur, definitely. He also likes, daredevil hobbies like soaring on these engineless planes, skateboarding. You'd never see Nassim Taleb on a skateboard. I mean, I would love to see that image. So yeah, they've got very different interests in life. Nassim is, as he will tell you, and has told me dozens of times, he does not see himself as a Wall Street guy, as a trader, as a finance guy. He wants to be known as a thinker, as a philosopher, as a scientist. Which I think he's achieved with his books and his research. People still associate him a bit with Wall Street, and especially Wall Street people associate him with that. But I think more, like his more popular image is somebody who writes these fascinating books of philosophy. And whereas Mark is very happy to call himself a trader, and that's all he wants to be known as. He has written some fascinating books, but they're very trade oriented books. So, I think it's why Nassim couldn't stick with it. He just didn't have the love of the game that Mark does. And Mark, as I say in the book, when they shut down their first hedge fund, Empirica, he was furious. He was like, this is a great strategy. Why are you doing this? Don't you realize what we can do with this? And Nassim was just like, I've had it. I can't do it anymore. I think he was concerned about the impact on his health that it was having. He really stressed out. Whereas Mark he believed in the strategy. He understood that you had to go through these periods of losing, but it was going to pay off. He thought. So he relaunched it, shut down Empiric in 2004, started up Universa in 2007. And, it's had a very successful run. So he was right.
So when you think about Nassim and kind of wanting to be more of the thinker, the philosopher, the scientist, kind of the non-trader, is it almost, there's a guy, Rob Henderson, he talks about like luxury beliefs, right? And the ability to want to be that because you already made the money, right? It is like, if you were just starting out, maybe actually you would be much more focused on Wall Street because it was about the pursuit of financial freedom. And then once you get it, now all of a sudden it's like, hey, I don't care about that anymore. Now I want to be more in this other realm. Do you get the sense in your conversations with Nassim like that's part of this, is that they actually had so much success early on, and then that provided the opportunity to not worry about Wall Street finance, trading, and kind of personal finances?
Yeah, absolutely. I mean, he's has said that the money that he made on Black Monday was more than he's ever made in anything else. Nobody really knows how much he made. Um, so he says that gave him what he calls "fuck you" money, and he could just go do what he want. I think he's always been a reader. I talk about when he was a kid growing up in Lebanon. He was reading all these books. There was a war going on in Beirut, and he was confined to the cellar, and he was just reading and reading and reading. So it's not like he made money and said, "Okay, I want to become an intellectual now." I think he always was. He just gravitated to Wall Street, and it was the '80s. It was a popular thing to do, and he was good at it, and he was also pretty good at math. So I think that the thing is, I was recently talking to him about this because, as Nassim's a very divisive figure um, on Wall Street. He can be very abrasive, and a lot of people just hate his guts. Uh, for one reason or another. Either he's attacked them, or on Twitter, or they just think he's an asshole. I think part of it is, especially among the top tier hedge fund managers, is jealousy. I know a lot of hedge fund managers. I covered the industry for years, and they all almost to a one see themselves as soaring intellectuals. With they've read a lot. They want to write a book. Many of them, some have written books, haven't done that well. And he's kind of done what they all secretly want to do, is become this popular thinker, not known for the money that they've made, but as being a intellectual genius. And I just think that there's a lot of jealousy going on there with him.
So you don't know this, but during his transition from Bitcoin supporter to Bitcoin critic, he came at me viciously, and I said to myself,
Oh, really?
I was like, yeah, I said, look, man, I got no problem with him. I still think of him in incredibly high regard, but I do think that part of the public like attacking of other people definitely puts bad taste in some people's mouth. But I always do wonder,
Yeah.
is that a requirement, right? For if you're so contrarian, if you have such a high disagreeableness, like we know that you have to be contrarian and right in order to kind of make outsized returns. Does that just kind of come with the territory? And if you think of sports as an example, Michael Jordan or Kobe Bryant, or name your favorite sports person, they got some skeletons in the closet of personality that people just kind of chalk up and like, well, he's the best basketball player of all time. Like, what'd you expect? He was just gonna be like this nice guy? Like, no, he's a killer, right? And
Right.
It seems like Taleb maybe has a little bit of that as well, and maybe that leads to some of the abrasiveness.
Totally. And he's always been like that. Just looking back at comments that he was making in the '90s about financial models and how stupid many of them are. And I think it took somebody like him to just say so forcefully that Wall Street's got a problem. It's using all of these models that hide risk and cut out the tails, like value at risk. He's been, complaining about value at risk for decades, since the '90s. I found some old writing from him that, was about how flawed that was as a risk model. And yet every bank, every hedge fund uses it. And, it works 95% of the time. But why would you use a model that cuts out the most volatile days 5% of the time of the year, and say, okay, we're fine most of the time. These outliers are going to come along, and we'll deal with them, when so everybody's looking at the middle of the bell curve, and Nassim is saying, no, that is not what you need to think about. You need to think about those tails, because those are going to kill you if you don't protect against those. And that's really, I think, more than anything, the innovation that he brought. Many people criticized him, and you can look at, it. One of the chief criticisms he's had to endure is people saying, no, we all knew about tails. And you can find, going back decades, research showing that there's these volatile events, there's these fat tails. And people were aware of them, but they weren't incorporating them into their trading models because it screwed everything up. I saw some email exchanges that he shared with me with a very senior financial theorist, a Nobel Prize winner, actually. And this Nobel Prize winner was telling Nassim, yeah, we know about the fat tails, but the problem is when we put them into our models, it makes things a lot harder. And it's difficult to trade on them. And it seems like, well, okay, you're ignoring reality, and that's going to be a problem for you. And it's kind of funny, like after the global financial crisis, value at risk was just completely discredited. I know we at the Wall Street Journal, we wrote about it, and how this is one of the problems that the banks had, is that they didn't see the risk in the housing market, because they were just looking at these average returns over years and didn't, it wasn't even in the models. And even a lot of the derivatives that were using these bell curve models with no fat tails. And yet, if you look at any financial disclosure from a major bank right now, they're using value at risk, the same thing. And that's how they're managing their risk. Now, I think that a lot more are aware of being, concerned about the tails, and probably are implementing hedge strategies. So hopefully, that will protect them the next time there's a crash. But, in early 2020, if the Fed hadn't come in with liquidity injections, like these massive liquidity injections and buying bonds and even junk bonds, we would have seen the same cascading failures again as we saw in 2008. So it's the Fed that's managing the tail risk right now.
It's fascinating to think that, Mark Spitznagel, now with Universa, which Nassim I think is still an advisor to, but Universa has become, probably based on everything I've seen, the best performing hedge fund over the last 10 or 15 years. I think in the book, when you kind of draw the line on the returns, they've averaged over 100% annual returns for more than a decade. Right. And we've heard of,
those are audited returns.
Yeah. So we've heard of obviously Renaissance and kind of 60+%. And, these kind of almost video game numbers, but Universa specifically having 100% annual returns over a decade is pretty impressive. But it feels like where Nassim is very public, and he's constantly going on television, he's constantly, kind of out there as that thinker, as that philosopher. Mark is much more reserved. He kind of is hanging out on his farm, and he wrote the books, but I don't see him, kind of volunteering to go and do interviews very often and things like that. And so, is that just his personality, or how did you read into that?
Yeah, I think he's definitely not nearly as interested in appearing in public as Nassim is. I think it also, kind of enhances the mystique a bit. You don't see Jim Simons of Renaissance coming on TV. In terms of returns, the medallion fund at Renaissance is probably unmatched. And for one thing, it's big. It's really big. I don't know how big it is now, but it's, last time I was looking at that fund, I think it was 50 billion. And to get the 80% returns on something like that year after year is mind blowing. I was actually the first reporter to get inside the Renaissance office more than a decade ago when Simons was stepping down. And I knew people, so I've written a lot about them. But Universa
What
is
was that like?
definitely
Hold on,
up
hold on,
there.
hold on. You can't say that just move on. What was that like when you go in the Renaissance office?
Yeah, it was cool because they brought us into their server room, which had all these big computers. Um, and I thought that was fascinating because I was looking at these computers and thinking like, what is going on inside those things? Everybody wants to know. They've always been you know a source of speculation and mystery on Wall Street because they seem to have cracked the code, and they've got all these PhDs, and so we walked around the office. It was funny. It was like they're off parts of the building that had a bunch of Chinese programmers, and then you go down a floor and they're like, "Here's where the Russians are." um, so yeah, it was very interesting.
When you think of Spitznagel today, you mentioned multiple times throughout the book that he's like on Zoom with his traders from his farm.
Yeah.
Uh, what is that about? Like, is this just because he's only got 21 employees and the strategy is kind of so simple and just it's about discipline? It's not necessarily about day to day decision making. He's able to spend time doing other things, or is there something else that we should take away from that?
I think that it can be, and this is just me speculating because I don't really know what they do day to day, aside from you know they're buying these far out of the money put options. But I think there is a bit of a machine-like quality to the strategy, and he doesn't need to be in the room uh, every day when things are happening. He can see what they're doing, what the portfolio is doing, and so it's easy enough for him to, you know, get on Zoom. I think probably he has done a lot more of that since the pandemic, like everybody. But if something crazy happens, he can jump on a plane and be in Miami in 4 or 5 hours.
Yeah. And then when you look out at kind of the strategy itself, even you seem to be a little bit like, okay, I get the general strategy, but how
Mhm.
do they actually do it is probably one of the number one questions you get. Uh,
Yeah.
what level of confidence could you say that you could go and explain to someone like the intricacies and the nuances? Is it something where they really are kind of close to their chest, even though they'll describe kind of the high level, but they won't explain the details? Or is it that the details are so complex that it's just really hard for people to wrap their heads around?
Again, I can only speculate, but I think that a big part of their strategy, which you can't replicate, on your interactive brokers trading account, is having relationships on well-established relationships on Wall Street that can allow you to put on these big positions in uh, these derivatives, these options that nobody else wants. I think they also have the stomach and the uh, market knowledge to know that these positions, which look like practically idiotic trades, uh, are going to pay off, and you just got to keep doing it because their trade is a bet on a 20% decline in the S&P 500 in a month, which is pretty nuts. Like, I think it's only happened a couple times. Um, when they launched Universa, the only time that had happened was in 1987 when the Dow went down 22.7% in a single day. Um, so that was one of the reasons they had a lot of trouble getting investors was, they look at it and say, well, this never happens. So, why would I put money into that? But I think one of the secrets of the strategy is you don't actually need a 20% decline for those options to surge in value. You just need there to be a lot of fear in the market that could happen, and that creates a sort of feeding frenzy on those positions. Everybody suddenly wants them because it helps balance out their risk in their portfolios, and Universe is there to provide that when everybody wants it. They're the ones who have those positions. They talk about like they're the only ones with an umbrella selling umbrellas when the storm breaks out. And so you can sell your umbrellas at a high premium. So it's, I think it's just the market knowledge, it's the contacts that they have. But the difficulty of the strategy is maintaining it in the most cost effective manner that you can. Because if you're trying to do this from your interactive brokers account, you're probably going to lose a lot of money uh, month after month, year after year. And at some point, most people, I think, are going to cut and run and say, forget that. you know, I'm losing money, and and they either don't have the cash to keep it up or the stomach to keep it up.
Talk to me about the risk of ruin. That seems to be one of the things that really kind of drives, part of their marketing, but also I think across Wall Street, people realize, hey, you can compound capital for a really, really long time, and it doesn't take that much to just all of a sudden lose it all. And obviously in these market crashes, that's a huge thing, and it's something you talk about throughout the book. Why is that so important, you think, as part of their marketing?
Well, I think it's a real risk, especially when you're using leverage. So, if you're in trades that are 30 to 1, 20 to 1, you don't need the market to go down that much to completely wipe you out. So that's the risk of ruin. It's also known as gambler's ruin. It's like Russian roulette. If you can spin the barrel a couple times and you might live, but if you keep doing it, you're going to blow your head off. And that's kind of what the ruin risk is you may survive, uh, like if you go in a casino and you put all your money down on red, you might make it a couple times, but eventually if you keep doubling down, you're going to lose all your money. And that's the risk they say that they avoid with this strategy is that they cannot blow up. And, that's the trade that originally with Empirica, Nassim wanted to devise a strategy that can't blow up. It can bleed, and you can lose money over an extended period of time, but there's no leverage in it. It's just you're buying these options, they expire, lost the money on that investment, but there's no way that you can in a big downturn with that strategy that you can lose everything. You actually make a lot. It's people know Nassim's book Anti-Fragile. I think that he hasn't told me this, but I think that he must have gotten that concept with this strategy because it's the ultimate anti-fragile strategy. These put options, you can lose the money on them, but when there's a big episode of volatility, they become anti-fragile. They become extremely valuable.
It's fascinating to think about the one thing everyone worries about in blowing up. They figured out a way to hang their hat and say, that's the one thing that we can ensure won't happen. Right. And it's almost this, again, this contrarian nature to it. Talk about the 4,400% return. So at the beginning of COVID, I think it was in March of COVID, they reported at Universa 4,400% return. There was a lot of people who were kind of, breath taken away, and they're like, "Oh my God, that's an incredible return." Then there's a lot of critics who were like, "That's bullshit." They lost money before, and all the critiques that came out. How do you look at that kind of just massive number that they posted in what was one of the most recent, really big market downturns?
It's probably where most people don't understand how Universa operates and how they report their returns. So, a lot of funds typically report on, like if they're $100 billion fund and they went up to 2 billion, they're going to say we had 100% return. So Universa is managing what they are actually doing is they're protecting assets, and when they disclose their AUM, what they're actually disclosing is the amount of assets that they have a protection portfolio on. So if they have, they're protecting 5 billion in assets, it's not like they have 5 billion in the market. They actually have a small percentage of that 5 billion actually in the market at any given time, of just a few percentage points of that. And that position, that sort of overlay on the portfolio that they're protecting, that what that does is that's what the 4,000+% return is on. So it's the return on the options that they had bought during that period of extreme volatility in early 2020. That's where you get the 4,000+% return.
And so what does that look like in terms of if they had $100 in the fund, if there's a few percentage points, let's say they had $1 to $5 actually deployed at the time in those options, for 4,400% return, that gets them still hundreds of percent on the total capital, but it's not the 4,400% on the entire fund size.
Right. Which would be crazy, right? 4,000% on 5 billion. I mean, anybody who knows the strategy, anything about it, they know that that's not what they were saying, but people still like to criticize them because either they're, competitors or jealous, or they just like to throw mud at Nassim and Mark. But I talk to tail hedge managers, and what I think irritates some of their competitors is that they don't report in the same way that Universa does. And they're like, well, yeah, I could have said I made 2,000% or 3,000% in early 2020, but that's not how we report our returns. And I'm like, okay, that's fine. Universa, is the original tail hedge fund. They created the strategy, and I feel like that gives them the right to report returns however they want.
Yeah. What's been the most surprising part? I mean, you've known these guys for a while. As you wrote the book, what was the part that kind of stuck out to you, or maybe the biggest insight that you weren't expecting?
I think that, how you can take this worldview that they've learned as a trader, as an asset manager, and managing risk, and how that can be applied to other parts of the world, like climate risk is something that I write about in the book, and something Nassim has written about, and with risks like that, there's these potential extreme events that could happen. You don't really know statistically how likely it is, but the uncertainty of the potential outcome of these risks is so high that you need to be very careful about managing that risk. And I think that with black swans in the market, you don't know it's going to happen. You don't know that there's going to be a crash, but the uncertainty about the potential of it means that you need to be pretty careful about it. Like Nassim likes to say, if you don't have trust in the pilot, don't get on the plane. It's the uncertainty of the possibility of these extreme events that people need to take into consideration. But it's also uncertainty that causes people to say, well, we don't really know how bad this is. Why should we take precautions against it? Because we don't really understand it that well. And, you saw that with COVID in 2020, there were a lot of people, especially early on, saying, well, we need to study this thing more because we don't understand the properties and how contagious it is or how deadly it is. So let's just wait and see and figure it out, and then we can decide what to do. And it's that wait and see mentality that's the problem. Is we wait too long and game over, and I think that's partly what caused the U.S. and other countries to have such, high fatality rates in 2020, 2021. And, I think that the original idea of the book actually came in early 2020 when I saw what Universa did. And around the same time, Nassim and some co-authors had written a paper in January of 2020 warning about the potential extreme risk that COVID posed, and saying we really need to be careful with this thing. It poses the risk of ruin. Let's take precautions. They were actually in contact with officials at the White House and they communicated that paper to the White House. And it made me think, like, what is it about Nassim's ability to see the extreme risk posed by COVID that kind of maps over onto what Universa did? Because it's, the same time you have, two people who have been engaged in the same market activities coming out looking pretty smart when everybody else is in total chaos and losing money, not understanding COVID. That's the thing that I thought, what is it about the way that they see the world that enabled them to get through this period of crazy risk and come out looking pretty smart?
And then when you look at Spitznagel, what do you think separates him from kind of everyone else? Right? Is it something about the discipline? And even Nassim kind of said, "Hey, I don't want to do this anymore. Right? I don't want to deal with almost the mundane kind of nature of it. Maybe he didn't want to be the front man, whatever. But like Spitznagel has stayed with this the entire time. What is it that separates him?"
Yeah. Yeah, well, I write about how when he was growing up, he was a very intense kid. And apparently, like, he told me he'd walk around his house, uh, muttering to himself, saying, discipline, discipline, discipline. And at the time, that was about his practicing on French horn. And he actually became like one of the best French horn players in America, and was accepted to Juilliard and was going to become a professional French horn player. And then apparently, his brother told me the story that he found out how much, like, the first seat French horn player in the New York Symphony made per year, and it was like less than a high school teacher made. And he said, forget that. And around the same time, he'd started going to the Chicago Board of Trade and just became fascinated with it. He just fell in love with it. I tell the story of how his father one day brought him to the CBOT, and it wasn't at all what he expected. And the energy of it, he just fell in love with it. And I think it just, something in him clicked that, was like, this is for me. Like, I want to do this. And he just dove into it, and it's just all, I think it's just a natural fit. He's a natural born trader. And the discipline that he learned, under Clip, about learning to lose, I think that mentality has separated him from most other traders who do not like to lose. It's also, I mean, if you think about the incentive structures on Wall Street, you most people, traders or money managers or whatever, they have their eye on their annual bonus, which that's all that matters for them, is how big that bonus is going to be year after year. If you're losing money year after year, you don't get a bonus. There's no bonus. So the incentive structures on Wall Street are just designed to pretty much force traders to adopt a strategy that's going to give them, steady returns, but they're taking this risk. And I think that, the bet is, well, if I can hang on for 5 years, and before I blow up, I'm going to have, a lot of money. Maybe they can make it longer than that, but that's not the way Universa operates. They make their money very incrementally, or very, very rarely. And, I asked them, how do you get your traders to stick with this? Because they don't have that, incentive of the big bonus at the end of the year. And they said the way they get them to think about it is like having an option in a company. And, when it goes public, you're going to make a lot. You're going to, it might be, a few years where you're not going to get much of a return, but when those options pay off, you're going to get a lot.
I want to read you a quote. This is a banker talking about a gentleman named Suleiman Olian. He is one of the richest guys in Saudi Arabia, built a massive conglomerate of a bunch of different businesses. And his banker said the following: "You could see clearly that he wanted to be successful. You didn't see him in bars or nightclubs. He was a serious person. He was always looking for new business, and he wanted to seize every bit of opportunity that came his way. He was almost compulsively ambitious." The reason why I thought of that specific phrase is he was a serious person. You could clearly see he wanted to be successful. Like all these points of this banker talking about Suleiman is very similar to what you're saying about Mark Spitznagel. But then it talks about he was almost compulsively ambitious. And one of the interesting things about this strategy is, to some degree, you have to temper ambition of doing things outside of the strategy, of losing discipline, of trying to get too smart or too greedy. And so it's fascinating to me, right? And I think in kind of reading the book of like, you have to be ambitious enough to want to do this and kind of stick with it, but you also have to be self-aware enough to know that if you get greedy, if you become undisciplined, you basically ruin the strategy and all of the value, dissipates very quickly, right?
Yeah. Yeah. It's a model. It's a strategy. And, Nassim has said he's never seen Mark stray from the model once. The protocol, as they call it, the Black Swan protocol. So it is definitely discipline. And I think it's just hard to do. And one important thing about the Universa strategy, as I point out in the book, is this is not designed to be a strategy for your whole portfolio. No one would put all their money into a Universa fund. You actually, based on the historic returns, you actually would have done pretty well, with very lumpy gains. It's meant to be a overlay of a broader portfolio of stocks and maybe some bonds. So, what Mark says is we recommend to our clients that you put 3% into our fund, and the rest you can put into stocks. And the idea is that, traditional portfolios, that many pension funds follow, is the 60-40 strategy of 60% in the stock market, 40% in bonds or other less risky assets like, maybe some gold and currencies, commodities. The problem with that strategy, according to Mark, is that you're giving up a lot of upside in the market. And that's really where your returns come from. And the market has historically done pretty well. The problem is that the market can be really volatile sometimes and go down a lot. So if you protect yourself during those volatile times and you have a trade that will give you this big infusion of cash when everything is down and are more attractive, that you're going to do pretty well over time. And that's basically in a nutshell what their strategy is.
It's fascinating when you see how long they've been doing this. And you mentioned that there's a lot of people on Wall Street that have started to kind of wake up to this. Do you anticipate that there will be many, many more copycats, including, could we see a BlackRock or other types of, Fidelity, like very, very large asset managers start to introduce these strategies as well?
They, some are, and there's some ETFs that are coming out. I somehow suspect that if the market continues to be pretty calm and trade up and down, but not the volatility that we saw in 2020, I kind of bet that the popularity of the trade is going to fade. And as we've seen before, I mean, after 2008, a bunch of copycats jumped in and launched their tail hedge funds and hung around for a few years. It's just the nature of this strategy that it's very tough to maintain over a long period of time. So we'll see. I mean, Universa has obviously attracted a lot of money, and that's going to cause people to say, well, I like those management fees. So yeah, there might be some more, but we'll see. I'm a bit skeptical.
Scott, Chaos Kings is the name of the book, How Wall Street Traders Make Billions in the New Age of Crisis. It is not only fascinating from an education standpoint. I think that one of your skills is you also write in a very entertaining fashion, so people can kind of read it and you just keep wanting to read more and more. I really enjoyed this book, so anyone who wants to go pick it up, Chaos Kings, Scott Patterson, I highly suggest you do that. I'm assuming you can buy this Amazon or any of the various books, also audiobook, ebook, or physical book. But Scott, if somebody wants to find you on the internet or kind of follow up with you on anything you talked about today, where can we send them?
Yeah, I'm on Twitter at Patterson Scott. I've got a website, scottpattersonbooks.com. And yeah, you can find the book on Amazon or Barnes and Noble, wherever.
Awesome. Well, listen, I really appreciate you taking the time to do this. As I mentioned, the book is fantastic, so I appreciate you entertaining
Thanks,
me
Bob.
for a couple hours as I read it. And we'll definitely have to bring you back when you write the next one.
Would love to.